One of the worst feelings in money is doing the right thing for years and still feeling as though nothing meaningful is happening. You save, you invest, you skip a few things. Other people seem happy to buy. You keep hearing that compounding is magic. Then you open the account, stare at the balance, and feel insulted. I understand that feeling better than many people think. The public loves the ending of compounding. It loves the charts that bend upward. It loves the old investor talking calmly about patience. It loves the phrase, "Let time do the work." What it does not love, and what almost nobody explains honestly enough, is that compounding is deeply unimpressive at the beginning. It is awkward. It is emotionally rude. It asks for discipline long before it offers visible gratitude. And that is why so many good people leave the game right before the machine begins doing what they were promised it would do. If you were sitting across from me at a kitchen table and told me you had been investing for a few years but felt as if the account was barely moving, I would not rush to reassure you with pretty slogans. I would tell you the truth. The early years are slow enough to break the spirit of people who do not understand where the turning point actually comes from. The problem is not that compounding is weak. The problem is that most people have no framework for the moment when it stops feeling like punishment and starts feeling like leverage. That is what I want to give you. A practical way to think about the flip. Not because life is ever controlled by one perfect formula. It is not. But because certain forces matter so much that if you miss them, you will almost certainly sabotage yourself in the exact stretch where patience matters most. I think of it as 4 connected pieces, 7 years, 5 categories, 3 emotional attacks, 1 annual increase. That is the architecture, not a trick, not a promise of overnight wealth, a structure strong enough to carry you through the ugly stage until the math begins helping you more than your mood can hurt you. Let me start with someone I want you to picture clearly. A young woman in her late 20s, intelligent, disciplined enough to try. Not glamorous in any financial sense, no trust fund, no fairy tale windfall. She has been investing $200 every month for years. She did what people told her to do. She stayed fairly diversified. She did not raid the account. She did not turn it into a toy. Then one day she checks the balance and sees a number that feels absurdly small compared with the effort it required to build it. And the thought arrives, is this even worth it? That is a much more dangerous question than people realize, because it does not usually arrive as rebellion. It arrives as disappointment. A person says, I have been good for years and the reward still looks small, so perhaps I am not actually building anything important. That thought has destroyed more futures than any bear market ever will. When people quit at that moment, they do not think of themselves as quitters. They think of themselves as realists. They say they are tired of waiting. They say they want their money to do something. They say life is short. Then they pull back, spend the account, chase something speculative, or simply stop contributing because the emotional return feels too low. And that is how the break point never arrives. What they do not understand is that compounding does not work like a salary. It does not pay you proportionally to how hard the first years felt. It works more like getting a heavy object moving. The early force is yours. The late momentum belongs increasingly to the machine. If you have ever pushed a dead car, you know what I mean. At the start, it feels ridiculous. Your legs burn, your shoulders tighten. The car hardly responds. The effort and the visible result feel insultingly mismatched. Then something changes. It rolls, not because the physics changed, but because enough force was applied long enough for motion to begin helping motion. That is the mental model most people need. The early stage of investing is not meant to flatter you. It is meant to test whether you understand the nature of the machine. The first piece, not vague time, enough time. That is why I care so much about 7 years. 7 years is not a mystical number. It is simply long enough in many cases to stop treating the market like a coin flip and start giving the underlying productivity of business and the arithmetic of reinvestment a real chance to express themselves. People who look at a one-year result and try to judge their whole future are usually doing something close to superstition. 1 year can be wonderful or miserable for reasons that have very little to do with whether your process is sound. The market can be up for foolish reasons. It can be down for temporary reasons. A short window tells you much more about weather than climate. Stretch the window and things begin changing. You give yourself time to live through a bad year, a recovery, an overreaction, and a normalization. You give dividends time to be reinvested. You give contributions time to stack. You give your own mind time to stop demanding applause from each monthly statement. That last point matters a great deal. A short time horizon turns every fluctuation into a referendum on your intelligence. A long time horizon turns fluctuations into scenery. This is one of the most practical reasons people should commit to a meaningful minimum holding period in their own minds. Without such a commitment, every temporary disappointment becomes an invitation to redesign the whole strategy. That is how compounding gets interrupted before it is strong enough to defend itself. I would rather see someone say plainly, "I am not judging this process before 7 years unless my underlying reasoning changes," than watch him keep pretending he is long-term while emotionally auditing the account every 6 weeks. 7 years does not guarantee riches. It does something more valuable. It forces you to think in a time frame where productive assets have a real chance to work, and emotional noise has a slightly smaller chance to dominate. That is the first shift. Now, 7 years alone is not enough if the money is arranged foolishly. This is where the second piece matters. 5 categories. Notice I did not say 5 hot stocks. I did not say 5 tickers that happen to be popular. I said 5 categories of exposure that play different roles and do not all depend on exactly the same conditions for their usefulness. One of the biggest mistakes people make is mistaking collection for diversification. If you own 5 growth funds that all move together, you do not have 5 categories. You have one idea wearing 5 shirts. Real diversification is functional. Each part must do something meaningfully different. The first category for most people should be broad productive ownership. Call it the broad market. Large collections of businesses, the major engine of capitalism itself. This is the foundation, because it lets you own the long-run output of productive enterprise without requiring you to guess which single company will carry the torch at each stage of the next 20 years. I have always respected broad productive ownership when bought and held sensibly, especially for people who do not want their life consumed by but it has one enormous virtue. It keeps you close to the broad growth of business rather than the narrow fragility of prediction. The second category is income-producing equity. Businesses or funds with a real culture of paying cash back to owners. Dividends matter psychologically and financially. They matter psychologically because they let the investor see something still arriving, even in periods when price action is disappointing. They matter financially because reinvested cash has a way of quietly adding force to the machine while the owner is busy being bored. There is a difference between owning a wonderful business that retains every dollar intelligently and owning a business or fund that sends part of the return directly back to you. Both can be useful, but a dividend stream can create a form of reinforcement that helps ordinary investors stay with the process when pure price appreciation still feels too abstract. The third category is smaller growth-oriented exposure. Here people often become foolish. They hear smaller companies and imagine they should fill the portfolio with exciting names and call it ambition. That is not what I mean. I mean having some measured exposure to areas of the market where growth can be faster, volatility higher, and long-run return potential different from the broad market. If properly sized, this category introduces a little more upside force without turning the entire plan into a casino. The reason sizing matters is simple. A category can be valuable in moderation and destructive in excess. Many people do not fail because they lack opportunity. They fail because they let one opportunity grow large enough to break the structure when it behaves badly. The fourth category is international ownership. This is one of those ideas people agree with politely and then ignore completely. That is a mistake. The United States is an extraordinary engine of business creation and shareholder value, but it is not the whole world. Economic leadership rotates. Currency regimes shift. Regional growth patterns differ. Valuations differ. Entire market cycles diverge. International exposure will not save you from every problem, but it can prevent your entire future from being more concentrated than you realize. You do not need heroic exposure there. You do need enough to acknowledge that the world is larger than one domestic narrative. The fifth category is defense. This is the least exciting and the most important whenever people are most tempted to dismiss it. Bonds, treasury bills, short-duration reserves, or similar defensive instruments exist not because they will make you feel brilliant in bull markets. They exist because compounding cannot help you if you panic and destroy the structure during a bad stretch. Defense reduces the odds that your whole emotional system gets hijacked during stress. It also preserves optionality. That word matters to me. A person with some defensive capital is not entirely hostage to market timing, personal emergency, or forced selling. He can pay a bill without liquidating productive assets at a terrible moment. He can buy when prices are ugly. He can wait. That is worth more than the average person appreciates. Now, step back and look at what these 5 categories really do. Broad ownership gives you the engine. Dividends give you visible reinforcement and cash compounding. Smaller growth exposure gives you additional long-run thrust. International holdings reduce concentration. Defensive assets help you survive yourself. This is not meant to be a rigid formula carved in stone. Asset allocation must consider age, temperament, job stability, outside income, and real human circumstance. But the principle is non-negotiable. You do not want a portfolio that can only work if one environment remains friendly forever, because no environment remains friendly forever. Which brings me to the third piece, 3 emotional attacks. I call them attacks because that is what they are. They do not arrive as calm thoughts. They arrive as feelings persuasive enough to destroy your process while pretending to protect you. The first is doubt. Doubt usually lives in the early years. You are contributing, the balance is moving, but not enough to satisfy the impatient animal inside the mind. Other people appear to be making money faster. One friend bought something speculative and doubled it. Another person talks loudly about a stock you do not own. You begin wondering whether slow discipline is just what cautious people tell themselves while bold people get rich. This is one reason the early stage is so dangerous. It does not merely feel slow, it makes foolish alternatives look intelligent. Doubt is dangerous because it invites strategy change before evidence exists. It tells you that boredom is proof of error. It encourages you to abandon a sound process, not because the process failed, but because it failed to entertain you. The correct response to doubt is not blind stubbornness. It is structure and memory. Why did I choose this? What assumptions am I actually testing? Have those assumptions changed? How much of my disappointment is really just impatience with the normal pace of foundation building? The second emotional attack is frustration. This tends to arrive after some real work has been done. You are no longer completely new. You have built something that should feel encouraging. But in this phase, the mind often plays a cruel trick. It compares the effort of several years with the still modest size of the visible result and starts saying, after all this is all I have. Frustration causes strange behavior. People withdraw money to reward themselves. They stop contributions for a while because the process feels thankless. They redirect the capital into more immediate pleasures or more exciting bets because at least those appear to produce emotional feedback. Frustration is close cousin to impatience, but it is often worse because it arrives after enough effort has already been spent that quitting feels partially justified. This is the exact moment many people should keep going, not because hope is a strategy, because the base that was built is finally getting large enough to become useful. If you interrupt it there, you turn years of setup into little more than a canceled launch. The third emotional attack is panic. Panic arrives when the market does what it has always done eventually. It falls, not gracefully, not politely, sometimes violently. Prices go down, headlines grow loud. Your account balance may fall below what you contributed. The comfortable story that long-term investing is easy suddenly becomes offensive because nothing about the current moment feels easy. Panic is the most dangerous of the three because it wears the mask of prudence. A person says, "I am getting out to protect myself." In reality, he is often converting temporary market pain into permanent capital damage. I have lived through enough market breaks to know something that younger investors do not fully believe until they have seen it with their own money. Crashes feel final while they are happening, and temporary only after they are past. That is why preparation matters. If you wait until fear arrives to decide what fear means, you will usually decide badly. The right time to plan your response to panic is before the panic visits you. That is what grown investors do. They decide in advance that volatility is part of the admission price. They decide that falling markets, if not accompanied by a broken life need for the cash, are not an automatic command to abandon productive assets. They decide how much defense they need, how much liquidity they need, how much checking they will allow themselves to do, and what historical memory they will deliberately rely on when the headlines start making ordinary people behave theatrically. This is why I dislike constant account checking for most people. It trains the mind to worship noise. If you are building wealth through a disciplined long-range process, daily observation often reduces intelligence rather than improving it. The market offers more emotional temptation than information on short time scales. Check less, contribute more, think longer. That is usually the healthier sequence. Now we come to the final piece, one annual increase. This may sound like the smallest part of the framework. In many ways, it is the quiet engine that changes a respectable outcome into a much more serious one. Most people think of investing as a fixed monthly number, $200, $300, $500. Whatever the amount is, they anchor to it psychologically. That can work. It is much better than inconsistency. But real life usually does not stand still. Salaries rise, debts get paid off, skills improve, children age out of expensive years, certain costs disappear. A household that keeps contributions flat forever is often behaving as though its life never changed. That is unrealistic. The trick is not to wait until you feel rich enough to contribute more. That day tends to keep moving away. The trick is to increase contributions automatically and modestly once each year. Even a small increase matters. It matters because contributions themselves compound. It matters because the extra money gets invested earlier than the mind would have chosen on its own. It matters because the annual increase trains identity. You become the sort of person whose future claim on income rises over time, rather than the sort of person who lets lifestyle absorb every improvement. And it matters because later wealth is shaped not only by market return, but by how much principal you steadily fed into the machine while your working years were still generous enough to do so. I want you to picture the difference. One investor contributes the same amount every year and feels quietly virtuous about his consistency. Another investor begins at the same place but raises the contribution a little each year. Not enough to create pain, just enough to ensure that growth in earnings does not all disappear into more spending. By the end of a long investing life, the second investor may not have lived much more harshly than the first, but the account will often tell a dramatically different story. That difference is not magic, it is priority. Now let me show you how these four pieces work together in a human life. Imagine a man beginning in his mid-30s. He contributes $400 each month. He is not rich, he is not destitute. He is simply ordinary in the most important sense. He has enough to start, but not enough to feel grand. At first the account feels slow. By year 3, he is mildly disappointed. By year 5, he is tempted to question the whole exercise. But he committed to 7 years, so he keeps going. He is diversified across real categories, so he is not blown apart by one bad area. He knows doubt, frustration, and panic are coming. So when they do arrive, they feel less like prophecy and more like weather. And each year he raises the monthly contribution a little. What happens? Nothing exciting at first, that is the truth. Then something subtle. The balance begins moving a little faster. Then something more important. The account starts producing amounts during decent market years that feel relevant compared with what he himself contributed. Then something deeper. He stops thinking of investing as a monthly sacrifice and starts seeing it as a machine that is gradually recruiting him less and helping him more. That is the flip. Not a day the sky opens, a stage in which the account begins making itself emotionally credible. People who never reach that stage assume compounding was oversold. People who do reach it often wish they had worried less in the early years. This is also why I keep returning to the importance of identity. The strongest investors I know are not those who always felt good. They are those who built systems that protected them when they did not feel good. Automatic contributions, pre-decided allocations, a clear time horizon limited account checking, a written response to crashes, a habit of increasing contributions annually. These things look boring from the outside. Good. Boring is underrated in finance. Excitement is often what people buy right before they regret something. I also want to address a misunderstanding that damages many young investors. They hear patience and assume passivity. That is wrong. Patience is not doing nothing. Patience is doing the right repeated things without demanding that reality reward you on your emotional timetable. A person who contributes monthly, raises the amount yearly, holds diversified productive assets, resists emotional sabotage, and keeps his horizon long is not passive. He is actively building a system. The drama happens mostly inside him because the world does not clap for private discipline. That does not make it less real. One of the cruelest aspects of the early compounding stage is that your sacrifice is highly visible to you while your results are not yet visible enough to comfort you. That mismatch creates vulnerability to every flashy alternative. This is why I am deeply suspicious of financial environments built around constant comparison. Social media, aggressive sales culture, sensational market commentary, and the endless display of apparent overnight winners can rot a sound investor from the inside. He starts comparing his year 5 to someone else's highlight reel. That is not only unfair, it is economically stupid. Your portfolio is not there to entertain your envy. It is there to buy your future. Treat it accordingly. I have said for years that the stock market is a device for transferring money from the impatient to the patient. That phrase is quoted often because it is neat. It is understood less often because people do not sit with what patience actually costs. Patience costs ego. It costs the ability to look boring. It costs the willingness to appear slow. It costs the refusal to draw conclusions from short intervals. It costs the discipline to keep contributing in environments where everyone else wants a new story. That is why so few people really own it. Now, let me be honest about one more thing. No framework eliminates risk. No asset allocation protects against every possible world. No 7-year commitment guarantees smooth success. What a good framework does is reduce the odds that you become your own worst enemy. That is a very high-value outcome. If you can reduce self-inflicted damage, if you can stay in productive assets long enough, if you can keep the structure intact through the inevitable emotional storms, and if you can steadily feed more capital into the machine each year, then you have moved the game strongly in your favor. That is the real objective, not certainty, advantage. I would also urge you to measure progress differently in the early years. Do not ask only, how big is the balance? Ask, did I contribute on schedule? Did I avoid breaking the structure? Did I increase the contribution? Did I remain diversified? Did I survive the emotional phases without redesigning my future in a fit of feeling? Those are real wins. People underestimate how much of later wealth is simply the consequence of not interrupting earlier discipline. A broken process compounds badly. A protected process compounds beautifully. There is a quiet dignity in that. You are not begging the market to make you rich this quarter. You are not begging a speculative narrative to rescue you from your own impatience. You are constructing an engine. And engines need time, fuel, and maintenance before anyone admires what they can do. If you keep this structure long enough, eventually a curious thing happens. The account becomes less emotionally insulting. The numbers finally begin responding in a way your nervous system can feel. The annual gain in decent years may approach or exceed what you personally contributed. That is when many people say compounding finally started. In truth, it started much earlier. You just could not feel it yet. That is the lesson I want etched into your mind. Do not confuse invisible progress with absent progress. Seeds do not fail just because they are still underground. I would rather you approach the next several years with clear expectations than with romantic fantasies. The first stage will likely look too slow. The middle stage will likely test your faith. The market will almost certainly try to frighten you at least once. A more exciting alternative will almost certainly tempt you. Life will offer reasons to pause contributions. Your own mood will offer reasons to declare the whole thing overrated. That is normal. What matters is not that these forces appear. What matters is whether your framework is strong enough that they do not get to redesign your future. So if I had to say it very plainly, here is what I would want for you. Commit to a time frame long enough that business productivity and reinvestment have a real chance to matter. Build a portfolio across real functional categories rather than a pile of correlated stories. Prepare for doubt, frustration, and panic as predictable visitors rather than shocking exceptions. Increase your contribution once every year, even if only modestly, so your future gains are fed by a rising claim on present income. Then hold the structure. You do not need to feel brilliant. You need to stay in the game. You do not need to win every year. You need to avoid permanent self-inflicted damage. You do not need to force compounding to move faster than its nature. You need to survive the stage when it still looks like a poor bargain. If you can do that, one day you will look up and realize that what once felt like pushing a dead machine has turned into riding one with real momentum. That is when people call compounding magical. It is not magic. It is delayed visibility. And delayed visibility is unbearable for the impatient, which is exactly why the patient so often end up owning the result. If I were speaking to a younger version of myself, or to any disciplined person now staring at a modest account balance and wondering whether the sacrifice is worth it, I would say this: Do not ask the early years to make emotional sense. Ask whether the process is structurally sound. Do not demand that the account flatter you before the engine is warm. Do not keep changing the recipe because the bread is still in the oven. Protect the timeline, protect the allocation, protect yourself from your own moods, keep feeding the machine. Then let the arithmetic do what arithmetic has always done for people who stop interrupting it. That is how wealth becomes far more likely, not quickly, not dramatically, but eventually, and with a force that only becomes obvious after you are strong enough to stay around long enough to see it.